Imagine this. You stake your Ethereum once, but you get paid twice.
Mm.
Now, that idea, that provocative idea,
Yeah.
it isn't science fiction anymore. It's a real advanced financial strategy being engineered right now.
Right.
And today, we are doing a deep dive into the mechanics of that exact strategy.
Yeah.
It's known as restaking.
But we're not just, staying in the abstract world of high finance. This deep dive is dual focus. We're pairing that futuristic engineering with something immediate.
Something practical.
Exactly. The practical reality of crypto, how you can literally pay without borders while you're traveling the globe using these next generation crypto cards.
That's the mission today. We're going to synthesize the mechanics and the practical street-level implications of two incredibly high-interest areas in crypto for you.
Yeah.
We've looked through the articles and the research, and they detail what's being called a major 2026 trend that's restaking. And we also have the specific solutions for, the headaches of global payments.
So think of this as your shortcut, your critical knowledge shortcut to understanding both next-gen payments and next-gen staking.
Exactly. We're moving from, the complexity of network security.
All the way down to the simplicity of paying for a coffee in another country. But we have to start, I think, by really establishing the problem that these crypto cards are trying to solve.
Okay, let's do that. So let's start with a scenario that anyone who travels regularly will understand. The classic bank headache. Whether you're a digital nomad, a business traveler, or you're just on vacation for 2 weeks, just ask yourself, when you try to use your traditional bank card abroad, how often does it just actively fail you?
The consensus from what we've seen is that traditional banks are, they're fundamentally failing global travelers.
How so?
These traditional systems, they were built around this old idea of a fixed local residency. They need to know exactly where you are, where you live.
Right.
Which means the moment you try to use them globally, the friction just becomes excruciating. Yeah.
Okay, so let's detail those specific failures. What are, say, the 3 major pain points that really define why traditional banks are so incompatible with global movement?
Well, the first one is just simple disruption. It's that constant fear that your account might get frozen.
Yes.
Banks block payments, they freeze cards, and they really struggle across different time zones when you're trying to verify something from a new location.
So you're in Tokyo trying to pay for a hotel, and your bank back in London sees the transaction at 3 a.m. their time and just assumes it's fraud.
Precisely. And the consequence of that isn't just, an inconvenience, is it? It's often disastrous.
Absolutely. Being stuck in an airport or a foreign taxi with a frozen card, that's a high-stress scenario that traditional banking just creates over and over again.
You're stranded. And that leads to the second major pain point, which is all about the cost of movement itself. We're talking constant cross-border friction.
So hidden fees.
Hidden fees, terrible exchange rates, or sometimes just an outright refusal at a shop. Your card just collapses the moment you cross an international border.
And those fees really do sneak up on you.
Yeah.
But the third one, for me, this one hits on the systemic barrier that stops a true global traveler from banking effectively at all.
It absolutely does. The third major pain point is being trapped by proof of residence. Traditional banks, they often demand utility bills, local documents just to open a basic account. This creates a massive hurdle for nomads or really anyone trying to manage finances across different countries without one fixed address.
It's like traditional finance requires you to have a physical anchor, which modern life just doesn't always allow for.
Right.
Okay, let's unpack this. So if traditional banks are the problem, built on residency, generating friction, the counterpoint here is the freedom of crypto cards.
Yes.
For someone who may be hearing about these for the first time or maybe hasn't used one, what is the core utility? What makes them so effective?
The utility is the immediate removal of that currency conversion headache. That's the main thing. A traditional bank adds layers of fees and poor conversion rates. Crypto cards solve this by instantly converting your crypto, whether it's Bitcoin, ETH, or a stablecoin, into the local currency right at the point of sale.
So if I swipe the card in a shop in Berlin, it's pulling, let's say, USDC from my wallet, instantly converting it to euros.
Yep.
And the transaction just goes through without me needing a German bank account or paying 3% in foreign fees.
That's exactly right. For you, the user, it feels just like using a regular card. But behind the scenes, you're avoiding all those punitive fees and the slow, complex processes of foreign exchange.
They're agnostic to borders and time zones.
Precisely.
That transparency is the goal. So when a traveler is choosing one of these tools, what are the essential features they should be looking for? What are the absolute must-haves for a functional travel card?
We found 3 that are, well, they're non-negotiables. First, you need genuine worldwide acceptance.
Right.
This means being tied into the major network, so Visa or MasterCard, ensuring the card works pretty much everywhere.
It's essential, obviously. What's number 2?
Robust digital integration. You know, in this day and age, if a card isn't compatible with Apple Pay or Google Pay, it's missing a huge chunk of utility.
Sure, for contactless payments.
And the third, which we really can't stress enough, is no hidden border fees. If a crypto card starts trying to act like a traditional bank by slipping in foreign transaction fees, it just defeats the entire purpose.
Okay, to make this more concrete, the sources gave us a specific example, Pinto Pay. What makes it a good case study for this kind of borderless payment solution?
Pinto Pay is described as a solution built for global movement. It's a great illustration because it targets those 3 pain points we just talked about directly.
Okay.
It works in over 150 countries with basically 0 border friction. It manages assets on one platform, so you don't need all these different local accounts. And crucially, it represents a specific category of crypto card we need to define.
That distinction is critical because not all crypto cards are the same, are they?
Not at all.
Can you walk us through that market segmentation? How do we categorize these?
We can really break the landscape down into 3 primary types, which should help you figure out which one fits your own needs.
Right.
The first type is exchange-based cards. These are probably the most common entry point. They're tied directly to a single exchange, so think Binance or Coinbase.
Okay, so the advantage is convenience if you're already on that platform.
Exactly. Your funds are right there, ready to spend. But there's a major limitation. They're often heavily geo-restricted. Their features, their fees, everything can change dramatically depending on where you physically live.
So if I move from, say, Europe to Asia, my exchange-based card might just suddenly stop working, even if my crypto's still there.
That's the risk. It's like comparing an airline's loyalty card to a globally accepted debit card. One is restrictive, the other is flexible.
Right, which brings us to the second category.
The second category is fintech solutions. And this is where a company like Pinto Pay fits in. They are independent solutions designed specifically for global movement and flexible payments.
So they're not tied to any one exchange.
Correct. Their focus is pure utility, low friction, and global acceptance, regardless of where you trade. They're built for the nomad, not just the trader.
And the third category.
The third is what we call white label cards. These are essentially the infrastructure providers.
The plumbing.
The plumbing, exactly. They supply the back end, the regulatory framework, the card issuance, everything another company needs to launch their own branded crypto card.
So if a smaller crypto project suddenly launches a Visa card, they're probably using one of these providers.
Most likely, yes. Understanding these 3 types really helps you choose. Do you need ecosystem convenience, pure global utility, or are you maybe trying to build your own solution?
That's a fantastic framework. So we've established immediate utility, solving real-world physical problems. Now we need to completely shift gears.
It's quite a contrast, yeah.
We're going from practical mobility to complex, futuristic financial engineering, from the street-level convenience to the highly complex architecture of network security.
It's a big jump.
And here's where it gets really interesting, because we're moving into a concept that's being described as the biggest trend of 2026. We were talking about restaking, or double stakes.
Restaking is it's an advanced yield strategy that's gaining massive momentum. It's primarily centered around a protocol called EigenLayer, which the sources detail.
Okay, so let's start with the basics.
The foundational knowledge we need is this. When you stake Ethereum, you're committing your ETH to help secure the Ethereum network, and you get rewarded for that service.
Standard staking.
Restaking takes that concept and layers on a whole new level of complexity. It's the mechanism where users take that already staked ETH, or tokens representing it, and use it to simultaneously secure other protocols on top of Ethereum itself.
So the same capital, the same collateral that's already protecting Ethereum is now performing double duty. It's securing 2 or more distinct services.
Exactly. And we call those other services actively validated services, or AVSs. Essentially, the staked asset is being reused to provide crypto economic security or trust to multiple layers of the ecosystem.
Can you give us an example of what an AVS might actually be? What are we talking about here?
Sure. An AVS could be anything from a decentralized Oracle network that feeds real-world data to the blockchain, to a new sidechain, or even a data availability layer.
I see.
They all need honest validators to operate, and instead of trying to build their own security from scratch, they just borrow the security muscle from existing staked ETH through this restaking mechanism.
And the reward proposition is right there in the hook we started with, getting paid twice. You get your standard staking rewards from securing Ethereum, and you get service rewards, often tokens or fees, from all the additional protocols, the AVSs, you're also helping to secure.
It's undeniably appealing from a pure yield perspective. It creates a very compelling financial structure.
Good.
But this is precisely where the analytical part of our deep dive kicks in. Restaking is an advanced strategy. It fundamentally changes the risk profile. It involves inherent high risks versus high rewards.
And the core question is always, what's the trade-off for that extra yield?
The trade-off is the multiplicative risk of what's called slashing.
Slashing.
Yeah. So when your collateral is only securing Ethereum, you only face the slashing risk imposed by Ethereum's rules if a validator misbehaves. But when you restake, your ETH is simultaneously subjected to the slashing conditions imposed by every single AVS you choose to secure.
Wait, hold on. So if I secure 3 different AVS with my staked ETH, and just one of those AVSs suffers a critical failure or a breach, is my entire underlying stake on Ethereum at risk?
That is the crucial question that the sources raise. The risk is that the penalties for misbehavior, the slashing events, they're cumulative.
So they stack.
They stack. If an AVS suffers a failure and they have a penalty condition written into their smart contract, that penalty will be levied against your staked ETH. You now have multiple attack vectors on your single piece of collateral.
That significantly increases the complexity of due diligence. You're not just betting on the security of the Ethereum network anymore. You're now essentially performing a security audit on every single AVS you validate for.
Exactly. The increased rewards come with a multiplicative increase in responsibility and potential loss. If an AVS is poorly coded or gets exploited, your staked ETH could be reduced or even wiped out.
So the real value of knowledge here isn't just knowing what restaking is, but understanding that you have to vet the risk profile of every single layer you're securing.
It is high yield, but it demands very high expertise.
That's a powerful and, frankly, necessary dose of reality. So we've spent this deep dive exploring 2 vastly different poles of the crypto world.
Very different.
On one side, we have immediate physical utility, solving the real-world problem of borderless payments with these transparent, low-friction crypto cards.
And on the other, we have this complex, high-yield, high-risk financial engineering demanding a really deep understanding of collateral risks through restaking.
If we zoom out and try to connect these two, what's the theme that runs through both solving the travel problem and this double stakes problem?
I think it's the theme of choice and context. What we learned is that in this solution landscape, whether you're picking a crypto card or deciding whether to restake, there's truly no single best option.
Right.
The optimal choice always depends entirely on your specific needs, your context, and fundamentally your personal risk tolerance. Utility always has to be balanced against risk.
Absolutely. So let's leave you with this final thought to mull over. We established that traditional banks are struggling immensely with just the basic logistics of global movement. They failed at simplicity.
Right. They're still fighting an ancient battle against geography.
Now, in the crypto space, we see strategies like restaking, layering, incredible complexity, multiplicative risk onto the fundamental security of the network itself. So if the old world struggles with simplicity, what future challenges might crypto face as it continues to build more and more complex layers on top of its security foundations?
It's a huge question. It challenges the very idea of what decentralization and security mean at that scale.
So consider that ultimate balance we discussed today. How much complexity can you layer onto a system before that complexity itself becomes the greatest security vulnerability? We'll leave you to think on that.